Hungry, actually. Maybe we should place that order.
Starting with all the talk about rice, and now there's the market.
And now Zomato.
Okay, but let the market open for the day, and then we'll place our order. The first tick on the index, almost 50 points in the green. So it looks like it's a good start. The Sensex up about 100 odd points. The Bank Nifty well in the green as well, and the mid-cap index is soaring. So not a bad opening at all. In fact, the advanced decline ratio also is well in the green, almost 1,900 stocks on the advancing side. Now let's take it straight to the large caps. You have L&T, SBI, ITC, Bajaj Auto leading from the front. Adani Group stocks are looking good. That group in any case has been in the news. So Adani Enterprises up 3%, Adani Ports up 1.5%. Steel stocks are not doing too badly. Tata Steel, JSW Steel in the green right now. And you have a couple of more names actually. Coal India, Tech Mahindra, Hindalco, ITC are trending in the green as we speak. On the downside though, I was talking about how these domestic economy facing stocks are under a bit of pressure. Britannia once again is down about 0.3%. HUL is in the red as well. Nestle, Tata Consumer Products, Bajaj Finance, a couple of other names that are in the red as we speak. Titan as well, not doing that well this morning. But otherwise, it's a decent opening. No, no two ways about that. As we said, whenever the market gets to the lower end of the range, there's buying, and that's what's spiking today. The mid-cap end of trade, though, is doing much better.
Oh, yes, absolutely. It's a big move on mid-caps. I'll quickly start with the newsmakers. So since we were just talking about it, Zomato is, doing well, 3.5% up. Let's not forget Indostar. Indostar has sold off a large chunk of its loans to one of the ARCs. And obviously, they receive money for that. 5% up on that stock as well. Some of the Adani Group stocks are up and about. Remember, a lot of the Adani stocks are going to be in focus because the matter comes back up in the Supreme Court tomorrow. Some green on the stocks for now. Ambuja, Adani Total Gas, the bigger ones, Ports, Enterprises. Basically, there's some smatter of green on Adani. Linde, because of the big order coming in from SAIL India, 3% up. BHEL, BEL, a lot of these PSUs have announced order wins over the weekend, and most of them are holding up positive as well. So these are some of the key newsmakers. Now the rice guys, there's some additional red. So we need to see the exact flow through in terms of impact if there is a ban on rice exports, basmati rice exports in excess of $1,200 per ton. KRBL, LT Foods down about 2 to 3%. Those are some of the names on news. But even beyond news, it's a buzzing screen out there. Look at India Cements, look at Piramal Pharma, look at some of the other names like NMDC Steel, which have been active. So not bad. For the time being, Prashant, mid-caps outperforming the large caps.
Oh, yeah, absolutely. And it's a very vibrant screen. 5:1, by the way, almost in terms of advances to decline ratio. I think you guys mentioned Atul Auto. Atul Auto had a big week last one. So it was up 25% last week, and this morning it's up another 6%. So that's a very large mover with very large volumes as well coming through. There is Sirma, which is up 5%. Again, just highlighting things with the largest volume. Sirma is at about 564. You look at Adani Enterprises, I think we mentioned, that is, of course, up about 3% or so. GMDC has been a mover off and on, but this morning it starts about 2.5% higher. There is Gabriel India, which is up 5.5% on decent-sized volumes for this point in the day. And there is Bajaj Hindustan, India Cements, Jamna Auto, which are some of the other large movers. Skipper Limited is another one, which is up about 205 rupees. That is coming up with about a 6.5% pop right now. So, yeah, I mean, there is a lot happening. On the downside, I can't see anything large at all. I mean, KRBL with a 2.5% cut is perhaps the biggest volume-led loser. Otherwise, it's mild. Bajaj Finance, for example, it's down a little bit, 0.5%. Titagar is down 1%. HCL Tech, Parag Milk and Emphasis are some of the others, which are starting a little lower right now. APL Apollo is down 1.5%, so keep an eye out on that one. As I said, I mean, overwhelmingly positive, at least in the broader market, mid-cap side with 5:1, a kind of advances to decline ratio. Let's so welcome in Rahul Singh, Chief Investment Officer, Equities at Tata Mutual Fund, who's joining in to take some questions. Rahul, good to have you with us here as always. Thank you very much for your time. Stay on track, stay invested, stay fully invested. Rahul, is that the advice? Should one start to think about mid caps versus small caps and large caps versus mid caps and that kind of thing, or it's okay out there, even mid caps and small caps?
Yeah, hi, good morning. I think stay on track is the right message, whatever was your asset allocation between equity, debt, or large cap, mid cap, small cap, because each investor is different. But stay on track probably is the right message, because what we are seeing is continuation of what we have seen in the last 1.5 years, really, that the Indian economy is seeing a broader recovery than what we have seen earlier, even though we are not, nowhere near the heady days of 2006 to 8 of 8-9% GDP growth rate. I think 6-6.5% GDP growth rate with a broad-based growth is definitely something which is leading to a broader market movement and not just large caps. So therefore, we are constructive on small and mid also as a segment, because that's where most of the resurgence, or let's say the revival, seems to be happening, given that last decade was really not something to write home about in terms of the investment cycle. And that is the one engine which was missing from the economy, and that is the engine which has restarted in a small way. So therefore, I think the idea is to stay on track, and I think whatever we are seeing in the market is a healthy consolidation phase, I would think.
Okay, a healthy consolidation phase, and the idea is to stay on track. Rahul, thanks a lot for joining in and speaking to CNBC TV18. You know, the one space that has made a big comeback this year is capital goods. And I'm talking specifically about L&T. I mean, this year, if you map it, right, L&T is up almost 30%. And we do know that there is a bit of a revival in the Capex cycle. These long cycle, diversified EPC companies have started to do very well. Is there more to go? Do you think this is just the start of the upcycle here?
Well, we can't comment. I can't comment on individual stock, but overall, as I mentioned, I think the investment cycle has 3 legs: government, private sector, and households. Government, obviously, last 2 budgets, you've seen that they have used more of the fiscal deficit for Capex rather than OPEX. You look at the private sector, the Capex revival is definitely real. Some of it is because of competition like cement, etc. Some of it is because of China Plus One. Some of it is because of energy transition. And also remember that the balance sheets are quite clean. Companies are generating cash flows. Bank balance sheets are the cleanest they have been in the last 10-12 years. So overall, it's a perfect situation for investment cycle to start reviving. And the last leg, which is the individual, the household, you've also seen a revival in the real estate. So basically all 3 segments of the Capex cycle or the investment cycle are doing well. So I think the chances that this sustains are pretty good, because the drivers are not just one. For example, in 2006-8, it was just infrastructure. Today, it is infrastructure, it is energy transition, it is China Plus One, and real estate. So the chances that even if one of the drivers slows down or falters, you would have some of the other drivers leading to sustained investment cycle performance. And as I mentioned, we may not see the heady days of 2006-8 when the investment cycle or the GFCF growth was 15-16%. But even a high single digit is good enough to generate growth for the companies, especially in small and mid.
Got that. By the way, the market slipped into negative. So the bulls are not going to like this on a day when you have so much of green on global screens and you have Asia up between 1.5% to 2.5%. We are not finding a follow through, at least on the headline indices. A little tinge of red on the Nifty. The low, just to keep it in mind, Friday's low was 19,229, roughly 19,230. We're far from that, but let's see. Bulls are finding it difficult to retain the momentum, already flat for the timing. Even the mid-cap market has cooled off from the day's high. Rahul, hi, good morning. I guess purely from a Nifty perspective, while, as you say, a lot of the macros probably are in place, but purely from the Nifty perspective, the last 1 month has been interesting because FPI flows have reduced compared to the deluge that we were getting in April, May, June. Maybe the data is skewed because of all the block trades that are happening, but the net number is lower compared to the highs of earlier this year. And B, there seems to be lack of leadership. IT stocks, I mean, not quite the torchbearers. Banks have been underperforming as well. What do you think is going on, and what can what can be expected, say, over the next 6-8 months as we get into the interim budget and then eventually to the general election?
Yeah, so I think we also have to remember that the interest rate narrative globally has changed a little bit. We were looking at 3.5, 3.6% US 10-year, and now it's 4.2, 4.3. So clearly there is a 50 bips movement there, and the narrative on the inflation is kind of become a little bit more hawkish than what was at the margin. It has become more hawkish than what it was, say, 1 or 2 months back. So clearly that is getting reflected in the consolidation phase, which I mentioned in the markets, and I think it's healthy. What we don't want is a runaway market because the macros for India go the broad-based recovery is in the investment cycle, and the fact that India is growing faster than most other emerging markets means that what we don't want is a runaway market or a bubble. So this is something which has come at the right time. I would think that the interest rate movement or let's say the confusion around which way the interest rates are going to go, rather than everyone assuming that there will be a rate cut in 3 months, 6 months, maybe the market is now probably 50-50 that there is going to be a rate cut or not this calendar year. So I think that's a good position to be in because it allows India to continue to grow at a steady pace, be in a situation which is a sweet spot, and continue to sustain this valuation premium which we are at today. And as I mentioned, I think as far as leadership is concerned, I won't really delve too much into it because when the economy is becoming slightly broad-based, there is unlikely to be a clear leadership sector-wise. And that's fine. I don't think that is necessarily a limiting factor for how the markets might shape up over the next 6 to 12 months.
Okay, just before we let you go, Rahul, then, just one question on what the big risk factor is now for the markets. Of course, we're heading into an election year as well. There is all of this talk about perhaps the US entering into a recession. Are any of these factors something that could derail the market in the near future, or do you think this uptrend is intact in the medium term?
I think the risk factors have to be commodity prices and crude as far as India is concerned. These are always risk factors, but right now there is a little bit of complacency there. I don't see much changing there though, but there is definitely complacency there. So that is something which I would worry about, especially if China comes out with a stimulus, again something which we don't know about, but that revives the commodity prices and crude prices. Then we are potentially looking at some of the macro factors which is leading to a sweet spot, which I mentioned earlier, kind of getting diluted for India. And of course, the general elections remain difficult to call so early. That's something which we will have to assess as we come closer to that.
Okay, we'll leave it at that, Rahul. Thanks a lot for joining in. Appreciate your thoughts. Well, earlier, just a while back, we had a chat with LT Foods on the export restrictions on basmati rice, and the management clarified to us that the curb on basmati rice exports will not impact them at all. They said that, at least LT Foods said that the export restriction is largely for parboiled rice that impacts geographies like Iran, etc. But what will this impact be on other names? We have the management of KRBL joining in. Akshay Gupta, who's the head of bulk exports, joins in on the phone line. Akshay, thanks a lot for being with us. Your thoughts on what these safeguards on basmati exports, what does this mean for a company like yours?
Yeah, good morning. Good morning. So in regards to KRBL, there's a $1,200 MEP implemented for basmati rice. Again, for us, it will be a very limited impact because we are into consumer packs and mainly into the branded segment. So $1,200 MEP would, most of our, I think 90% of our exports would be above $1,200 mark. So I don't see a big impact on KRBL. And secondly, this regulation is implemented till 15th of October, which is just around 45 days from now. So, so the new crop will start coming in after 15th of October itself. So I don't think we could see a big impact on KRBL.
Actually, just to clarify, so $1,200 per ton is the MEP till 15th of October. Now, the differentiation between branded and non-branded, as long as someone has, branded exports, branded, packaged in a pack, and then the value is below 1,200, would that entity also be exempted? Or the first threshold is that, yeah, that's what I'm thinking. MEP is the first threshold, right?
MEP is the first threshold. Anything below 1,200 would be impacted. Anything below 1,200 would be, yeah.
Okay, so you're saying 90% of your exports are above 1,200, so not really a problem for you. What about, your peers and industry in general? When we talk about basmati rice exports, in general, are most people above 1,200, or what percentage would be impacted?
No, I would say, we've looked at the data as well, the export data. The average exports of basmati rice from India in the past year has been at 1,050 to 1,100. So that has been the average price. And those segments will be impacted because...
And what percentage would that be? Yeah, so what percentage would that be? The ones that are, as you're saying, 1,050 to 1,100, because they can't export anymore, at least till the 15th.
Right. So, see, most of the orders, since it's a annual crop from October to December, and we are at the end of the season, so most of the shipments for the year have already been made. It is just 45 days remaining for the new crop to come in. So people must be at the end of their contracts, just to complete the contract before the new crop arrives. So the impact overall to the industry would be limited, but there will be, I would say, more than 50% of the industry which will be impacted by this, but they would be finishing their contracts. So I think small quantities would be impacted, yeah.
Okay, so the impact will be minimal. Got that. When we also spoke to LT Foods, they said that the value growth in the export segment is very good. They're looking at double-digit growth coming along, and they've done 18% growth already. Can you tell us a little bit about KRBL's growth? What have you seen so far, and what is the prognosis for the full year?
So, in terms of exports or just
Yes, overall? In terms of exports. Even overall, if you can share with us.
So we've always maintained that we'll maintain double-digit growth. So around 10 to 15% annualized growth we see in basmati market. India market is growing quite strongly because of the conversion from non-branded to branded segment. And even exports, we are getting into increasingly new markets and, getting new distributors on board. So we should see double-digit growth. We'll maintain 10 to 15%.
All right. We'll leave it there. Thank you very much, sir. Appreciate you joining in and running us through all of that. There is an important news flash at the bottom of the screen. The Kerala High Court has quashed the enforcement case registered against Mr. Nandakumar, who is, of course, the promoter of the company. So that is definitely positive. It's been kind of developments since have been going in that direction, but I think now this is in a way the court, from a legal standpoint, has completely quashed the proceedings which were initiated by the ED, etc., against the Manappuram promoter. So that's what we are looking at. Well, let's talk about Supreme Industries, which is the next company which is on our radar. They've signed a memorandum of understanding with Parvati Agroplast to acquire their PVC pipes business for 235 crores. To know more on this in terms of how this will sort of, add to Supreme, its capacities, its revenues, etc., we have Mr. MP Taparia, Managing Director at the company, joining us. Mr. Taparia, it is always such a pleasure speaking with you, sir. Thank you very much for your time. Prashant this side. And congratulations on the acquisition. Could you...
Thank you very much.
Thank you, sir.
Thank you very much. Good morning. Yeah, please.
Good morning. Could you tell us what does this take Supreme's total capacity to? Because the company that you're acquiring also, I think, has some other sort of new capacities which are to come on stream. Once completed, what will be the total sort of capacity? Addition to Supreme's capacity. So what will be the total capacity? What will it look like? And what's the revenue potential from this acquired entity, sir?
First, I must correct the number that we have acquired it at 171 crore, not at 235 crore, please.
Okay.
And our current capacity overall is 800,000 tons. And this company has installed capital 36,000 tons. We have made a plan to expand the capacity further of around 20,000 tons. And with the other ongoing investment program, we should be close to 900,000 tons by March 2024.
9 lakh tons by March 2024.
2024. Yeah, please.
Okay, and this includes your own expansion, the expansion from the capacity of the acquired company, everything.
Our own expansion and also this company which we acquired, and plus the investment what we have committed. We are not clear when the final delivery will be available of the other equipment we ordered. Overall, the company had a plan to reach 1 million tons by 2024 December.
Okay, 1 million tons is the capacity that you plan to reach by 2024 December, correct?
Yes, please.
Oh, okay, all right. Can you tell us the... Sorry, what did you say?
36,000 ton of this company present capacity and additional 20,000 ton we are adding.
Okay.
So 56,000 will be additional capacity coming because of this Parvati acquisition.
Okay, so additional capacity will be in excess of 50,000 tons because of the acquisition. Can you tell us this, Parvati Agro Plus delivered a revenue growth, a compounded growth of almost 45% in the last 3 years, if I'm not wrong. Is this something that you can replicate, and what kind of operational margins can you get because of this acquisition? I mean, what will the blended margins look like?
Overall, this year we anticipate to earn 14% margin, and with this acquisition also, because they make oriented PVC, which is a high margin product, we hope that we will maintain our operating margin at 14%. This company, the seller commits to us that he will be able to get all the permission to enable us to operate the plant from 1st October. In the event we succeed to acquire the company on 1st October, then for the 6 months, we may get additional turnover of 120 crore rupees, and next year 350 crore rupees.
But sir, as you're saying, this company, Parvati Agro, it operates at similar margins as your margins, 14%.
No, Parvati is not able to operate the plant because they have got tremendous working capital problem.
Okay.
So they are not able to operate. But the capacity what they have created, we will be able to run the capacity fully.
Okay. All right. Got that. And also, the expansion that you'll be undertaking, that will be at this land, which is, I think, just, this company also has a large parcel of land, and that's where the expansion will happen?
Now, overall, our capital investment now will reach 1,000 crore rupees, out of which around 800 crore will be required to pay in this financial year.
Okay. No, so I'm trying to understand that I believe that Parvati Agro also owns a large piece of land that's valued at close to 170 crores. What do you plan to do with the land? Or is that where the acquisition, is that where the expansion happens?
Land will be used by us for expansion capacity.
Expansion.
We'll be adding some new products. We'll be doubling the capacity of PVC pipe. We'll be doubling the capacity of OPVC pipe. And we are putting tank manufacturing capacity the same site.
Okay. I got that. So, sir, the Parvati Agro's sort of clientele is largely all government bodies, right? Is there any, historically a problem on the receivable side, etc., for Parvati?
Sorry, say it again, please.
So, for the company that you've acquired, the clientele is largely government bodies, right? State government bodies, etc. Their clients are largely government bodies, government organizations. Is there any receivables problem there? Are there any pending receivables for the company?
We'll be factoring exactly as on end September. If the monies are not realizable, that will not be paid by us. We are not running any risk.
Okay. Sir, just one final question. You've also entered into this PVC windows and doors segment. Just wanted to understand a little more about that segment. What is the kind of growth opportunity do you see there? I think last time you said that it has a revenue potential of 350 crores. Is that in year one? And what kind of sustainable growth do you see in this new segment?
You see, we are putting a capacity to manufacture 10,000 tons of window and door.
Okay.
We anticipate that this is going to be a huge market. China sold last year 4.5 million ton window and profile. India, we sold only 80,000 ton. we see tremendous opportunity in our country. We acquired land at Kanpur, 32 acres, and we will be now taking action to place equipment order, and we hope some product will come out in the year 24-25.
Okay. So what would this mean for the revenue potential by the end of FY25? What are you looking at year 1, year 2, post the capacity coming on stream?
When the plant comes, I can tell you properly, but I think on 5,000 tons, and we'll be installing immediately 5,000 tons. The revenue should be more than 150 crore rupees.
Okay, 150 crore rupees from 5,000 tons.
For 5,000 tons. Because it is
Okay.
we'll be making a window and we'll be selling window and we'll be selling profile. We'll be keeping hybrid model.
Okay. At what margins will this come, sir? And what margins?
Margins should be better than 14% what we are earning. Because Finesta is one company, margins are known, they earn more than 20%.
Okay. So on margins, you said that margins for the full year should be about 14%. Correct me if I'm wrong. The number I have, what you said after
For
the
our
quarterly.
company, yes. Our company, yes.
Yeah. You after the quarterly numbers, I think what you said
our
was
company margin. Sorry.
after the first quarterly number, sir, you had guided for 15% margins for the full year. So is there a bit of a drop off that you are seeing?
I told our margin 14%. We told 14%, very much. We told 14%.
Okay, then okay, fair enough. So 14.
No,
Got that.
we told 14% plus.
Got that.
And
Sir,
are looking quite robust.
Okay. So how is broadly? I mean, for each of your segments, right? I mean, how is demand looking? Is it going to? I mean, is it looking as robust? Because volume growth was super strong in the first quarter. For plastic piping product segment, which is 75% of your business, how are things looking for the rest of the year, sir? Just give us an update.
Business are looking quite robust. There's good demand from agriculture, housing, and infrastructure. The polymer prices remain at a low level. There's no indication the price will go up. So we anticipate, as we told, that we will have volume growth 20% plus. And for piping division, we will have a growth between 23 to 25% for the year.
25% piping segment volume growth and 20% overall volume growth.
Yes, please.
Okay, all right. We will let you go on that note, sir. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV18. By the way, for the market, it's now cooling off a bit. So as we were telling you, it just sort of, the minute there is a bit of a rise, the market sells off, and we're seeing that happen. This morning, the pressure is on domestic consumption stocks. HUL, Britannia, Asian Paints, Titan, Nestle, all of these stocks, Tata Consumers, are all down anywhere between 0.5% to 1%. Let's take a quick break on that note. On the other side, Ramani Dati, the CFO of TeamLease Services, will be joining in to tell us about the hiring picture as well as the quarter gone by. Later, we'll be joined by Rajiv Rajgopal, the MD at Akzo Nobel India, to talk about the outlook on their business. Stay tuned. Welcome back. This is Corporate Radar on CNBC TV18. Let's shift focus now on TeamLease Services. The company's margins are on a declining trend. There was a sharp decline in profitability also for the company in Q1. They say that they continue to grow with their larger customers, and for Q2, they have a healthy pipeline. Ramani Dati, the Chief Financial Officer at TeamLease Services, joins us now to discuss their business outlook. Ramani, thanks a lot for joining in. You know, you have articulated the reasons for the fall in the margins earlier, right? You spoke to us about how there's been seasonality as well in some of these edtech companies. There's been the core employee annual hikes as well that you had to look into. But have the margins bottomed out? And just trying to understand whether this is a structural problem or more of a cyclical in nature.
Yeah. So it's mainly two reasons specific to Q1, as you have rightly mentioned. So we have our core employee annual hikes impact as well as seasonality in edtech. And the second reason is our higher margin contributing businesses, which are the IT staffing and degree apprenticeship. So both of them had heavy headwinds in the industry right now. And that has impacted our margin substantially. Having said that, from Q2 onwards, from this quarter, we are expecting a steady improvement in margins, both in percentage terms as well as in absolute profits, mainly driven by the growth in staffing business, because we are seeing demand across sectors, be it BFSI, telecom, retail, consumer. Across all segments, we are seeing good growth. As of now, the only segment where hiring is not happening is in IT. Again, within IT, the GCCs fortunately have started hiring, and we are hoping that that trend will continue for next couple of quarters as well.
Okay, so when you talk about, that trend continuing, can you tell us when do you think the margins can get back to that 2% plus mark? I mean, any kind of exit margins that you're looking at by the end of FY24?
To be very honest, without recovery of IT, I don't think we can get back to the 2% margins at the company level. And for the time being, we are focusing mainly on the absolute profit expansion. Like Q2, we are expecting at least a double-digit kind of EBITDA growth on a sequential basis, and Q3 being seasonally high for staffing business with the festives and all of that. So we are hoping Q3 will be our highest contribution, both in terms of headcount as well as margin. But this year, 2% we may not be able to get to.
Can the big sort of uptick that we're seeing, and there's a fair bit of excitement, Ramani, now around GCCs, right? And the large potential that they offer, can they, in some ways, over a period of time, counter, the weight that IT services has for you as a business? Can that be a very large opportunity? I mean, how much is that as a percentage of your business?
So 2 years back, our GCC contribution in our specialized staffing headcount used to be 30%. And that number has now substantially grown to 50%. So out of the 8,000 headcount we have in IT, 4,000 is coming from GCCs and captives, which is a very healthy growth. And we believe that in the coming years, maybe it may take 3 to 5 years, there can be an equal contribution from GCC, similar to IT services in terms of overall employment in IT.
In IT, you said that, until IT doesn't recover, you won't be able to get back to the 2% mark. Just trying to understand this whole IT slowdown, do you think it's a prolonged period of slowdown? I mean, how long do you think it could last, A? And I'm asking because, the companies are winning a lot of large deals, utilization levels have gone up. So do you think that it's just a matter of time before the IT hiring picks up as well?
Very difficult to comment when the hiring will pick up, because as of now, at least within IT services, we haven't seen any kind of green shoots. As I said, GCCs are hiring, and next 2-3 quarters as well, we have visibility of good amount of hiring there. But as of now, the volumes coming from GCCs are still small. So only with IT services demand recovery, we can see a substantial jump in the overall hiring numbers. And how long this can continue, again, there is no visibility. It's already been more than 4 or 5 quarters now. And can it be extended? Maybe yes or maybe no.
So what is the overall headcount that you anticipate in Q3 and Q4?
So in IT, there won't be, because typically Q3 is a complete off-season for IT hiring. Q4 also, it would be more or less kind of a very nominal growth. But general staffing, we are expecting very good growth in Q3, because we have the festive season, and across all segments, we do the maximum hiring in Q3. Q4, we should do more or less similar to what we have done in Q4 of last year.
So just leave us, Ramani, with how you can sort of look out for the full year, considering all the trends that you described, with the IT still being subdued, but the general staffing business picking up, as you're saying, the market's very buoyant. Overall, full year FY24, what's the revenue visibility you have now?
Yeah. So we should be doing at least 25% overall revenue growth, even without IT being very strong in terms of both on headcount growth and revenue growth. But general staffing will drive the top line growth for us. And in terms of overall headcount growth as well, we are expecting close to 20%, mainly contributed by our staffing business. In terms of margin, as I said, it's very difficult to comment on margin expansion without the pickup in IT. So we are focusing on profit expansion. So sequentially, we are expecting at least a 5 to 10% growth quarter on quarter.
Okay, so you're just coming back to one number, right? I don't know if you can give me that number, but this PAPM, which is the per associate per month, kind of like your realizations. In Q1, it was 680, and you said that in the conference call that you're growing some of your large customers, but I didn't understand what the impact on that on your average realizations would be. From this 680 rupees number, do you think you can extend it for the rest of the year?
Yeah. Yes. So the PAPM with large clients, our negotiation power is relatively weak. With more growth coming from large customers, they'll continue be a pressure on PAPM. So that's why we are focusing on a well-diversified portfolio of large, medium, small customers and across all sectors and industries. In addition to that, we are also upselling value-added services to our customers, which will give us a higher realization on our overall PAPM. So with that, we are expecting that this year, we should get back to at least a 700 PAPM by end of the year.
All right, Ramani, got that. Thank you very much. Good chatting with you today and good to get perspective. So IT is basically where the trouble seems to be. Let's see if that improves over the course of the year. The market's absolutely flat, just about 10 points up on the Nifty. Mid-cap's doing slightly better. Let's talk about one pain stock that's done quite well so far this year, also over the last 24 months. And I'm referring to Akzo Nobel. Stock's up about 25% in the current calendar year. And the company did quite well in the first quarter as well. The performance was healthy as the company saw a big jump in margins, 400 basis points jump in gross margins. Profit was up about 43%. So raw material inflation cooling off has been a big tailwind for a lot of paint companies, including Akzo Nobel. The question is, what next? And how is demand looking as we get into the peak of the festive season? Rajiv Rajagopal, Managing Director at Akzo Nobel, is joining in. Rajiv, thank you very much for being with us. I want to start by taking the discussion to actually decorative, because though I know industrial is a huge part of your portfolio, but let's start with decorative, because I think the discussion on raw material we can keep aside for the time being with crude behaving itself. The question is what's happening with revenue growth, market share, and with so many new players and big, large, deep-pocketed players entering the market. The question is there going to be a big battle for market share, maybe competitive intensity, pricing competition? What do you see in the market today, and what do you forecast for the next 6 months to 1 year?
Morning to you, to Prashant, Sonia, and all the CNBC-TV18 viewers. Thanks for having me on your show. So firstly, with regard to the last quarter, we saw a bit of a growth which was slightly different from what we've seen in the earlier quarters. We saw higher growths coming in from our tier 2, tier 3, tier 4 towns, in fact, high double digit. And in fact, we saw a bit of a muted growth in where we typically have been very strong, which is the large towns and tier 1 towns, right? That's slightly changing. And I'm talking about decorative paints, and we grew, in my view, we held market share. We were sort of, if you look at the last fiscal, we actually added significant market share, and we've been adding market share in the last couple of years after many years, if you really plot the trend of Akzo Nobel stroke ICI. Yeah, so that's healthy, and our intent is to sort of move it there. Coming to your specific question and how the demand is, look, July was a bit tough. Impacted mainly by the monsoons, excess monsoons, but we do see a slow recovery. I think the recovery will be sharper in the 2 months before the festive typically, because this time Diwali is, in the second week of November. So we expect strong September, October. That said, I think we've just got to be a little careful because there are certain nuances in specific markets that we are sort of addressing as a team. But we've got our aggressive plans in place. Our advertising is in place. Our propositions and new launches are in place. Just to give you an example, we've launched now Dulux Assurance, what we call 2.0, where we've introduced a warranty program. So if any of you are planning to paint your home, you're also covered by a warranty, a specific warranty, and we've sort of launched that. And perhaps it's an endeavor, it's a promise of our quality, which we are very confident about. That's what really Dulux really stands for.
Sure.
Going forward from a fiscal perspective, look, we are still targeting double-digit growth. Yeah, I know the start has been a little slow. Maybe this quarter will also not be really, double-digit, but I do see that, I think our plans are in place, etc. Coming to your question on new players.
So, Rajiv, just before you answer the new player bit, you mentioned you've been gaining market share. Can you give us a number? You mentioned last time that you were at 5.5% to 6%. I just want to understand what's the latest number.
See, we had dropped to about 4.7 about 2 years ago, and we moved to almost about 5.5, 5.7 right now, trending towards 6, I would say. Remember that we are not a very big player in the putty, and in the decorative part, we look at with putty, without putty, and also some of the, we are playing in the addressable segments of the decorative.
Sure.
For example, we don't participate in lighting, furniture, and etc. So when you look at the addressable market, we would be sort of gaining significantly in the last quarter. And except, of course, as I said, last quarter, we would be, I would say, flattish. When you look at it, we've held share, we've not lost it. And we've sort of put some plans through distribution, accessing smaller towns, getting new customers into the portfolio, etc., as ways to drive market share.
Sure. Rajiv, good morning. This is Sonia here. So, it's very interesting you say that July was under pressure because of the monsoon situation. You're not alone in that regard. Every other paint company that we've spoken to has said that consumption has been lackluster. But now in August, there has been relatively not much monsoon. So how was the performance in August? Have you continued to see low single-digit growth? And given the kind of competition as well, combined with a slowdown in consumption, do you think you would have to sacrifice on your margins over, the next couple of quarters?
So, Sonia, look, we don't give a monthly sort of, guidance in terms of it. But how's August going? Yeah, it's better than July, but, not still where we would like it to be. But having said that, as I told you, we are certain that by September, things will sort of bounce back in majority of the states where, we seem to be getting a better traction. But still, I would say, not in line with what we want. From a quarter perspective, we are still hopeful, in terms of, getting towards the number. But again, as I said, I see sharper, recovery in the next quarter. Primarily because that's just before the Diwali season, and we see a huge. If you look at some of the sort of demand that's sort of coming across, not just in the retail side of the business, but also on the project side, seems to be fairly strong.
Sure. No, on the margin front, I was checking with you, and the reason I ask is because I understand that your ad spends as a percentage of sales is going to go up. So in that context, where ad spends are going up, competitive pressure is rising, and consumption is not that great, how much would you have to, sacrifice on margins?
So look, we've been at an EBIT margin of closer to about 13-14%. This is including the royalty we pay, and that's obviously we would be number 2 actually when you look at EBIT margins. Yeah, I think we are fine to sort of look at holding margins at this point of time. And so what's going to come accretive because of further raw material drops, we want to sort of make sure we are investing behind the business. Now, we need to wait and watch in terms of the some of the new players in terms of pricing. It's still early days, Sonia. A couple of players who've launched, say, 2-3 years ago, other than one player, I don't see too much of traction really. So really too early for us to comment in terms of really matching it. Yes, the discounts on the retail, on the decorative side of the business have slightly shot up. That's primarily because of the price increases we had taken earlier, and we've not sort of followed it with price drops because the crude is still very volatile, Sonia, and you are covering it well, right? It is one day it's 82 and the other day it sort of gets close to 90, and so is currency. So it's difficult for us to take a price correction, but we do hope to hold margins. That's been the endeavor that we are in.
Okay. Rajiv, sorry, the other point about distribution, right? You said you were into smaller towns and sort of getting new customers. You said you plan to expand distribution to between 30 to 35,000 dealers. By when and what kind of expenditure will you incur on this?
So, Prashant, we are going to sort of, good morning. We are going to look at a 3-year time frame, right? So, if you look at, we've now started covering almost 5,200 towns. We are now planning to take it over the next 3 years to 8,000. We are pretty much trending on it, right? In terms of expenditure, not much, because we've already got a distributor model, as you know, in place over the last 6 years, and almost 70% of our turnover of the decorative business goes through. It's a very steady model. We are doing well, perhaps one of the only players in the business which is driving it. And what we are doing is what we call hub and spoke, where we are building on our distributor model to access smaller towns, right? So the break even is less than 6 months. So really, from an incremental cost perspective, it's not really going to be a significant cost addition, Prashant, if I've answered your question.
Okay, you have. I had more, but another time. We're kind of running out a little time. Thank you very much. And I'm sure that warranty guarantee, there are different rates for customers with kids and without kids, right? So higher rates for customers.
Look,
Just joking.
No, but on a serious note, I think it's a fantastic product. I encourage all of you to buy at home. People who've used it, swear by the product. That's the biggest difference. I think our Solus users, if you look at, we 98% of Solus users use us back in 3 to 4 years, right? So that's volumes of the brand.
Done. We'll check it out, Rajiv. Thank you so much for joining us. It's a pleasure as always, and good luck. A good conversation as always. So
I actually need a paint job, at home. I was just
Now I'm
thinking
also
about it.
there you have it. So
But with young kids at home, it's I think maybe once in 10 years.
two new customers right there, Rajiv. Thank you very much for joining us.
Thank you.
We'll take a very quick. Thank you. Thanks very much. We'll take a quick break here. We'll come back. Markets absolutely flat. I think 10 points. I think Mitesh is with us, so let's just quickly go across to him for a check on things. Mitesh, hi, morning. What do you have?
Prashant, the index, as I said, I think not much happening over there, and therefore you trade stock or on a stock-specific basis. I think I have a buy on Godrej Properties that's showing good traction early in the trade. Buy here with a stop at about 1600 for targets of 1680. And HUL, disclaimer, we have had a recommendation on this to our clients as well, so there's some vested interest. HUL is a sell with a stop at 2566 for targets of 25.
All right. Those are sort of new trades coming through. Mitesh, thanks very much. We'll take a break here. We'll be right back.
Okay, folks, well, let's just take one quick look. There's really nothing happening in the market. It's so very flat. In fact, it's a good time to be looking outside the equity markets and into the commodity space. Manisha Gupta is with us. Manisha, good morning. What's the one commodity that you're tracking today?
Sonia, it has to be rice. I know we are talking about it a lot, but this really needs to be put in focus because India exports 40% of global trade of rice when it comes to that. And with all the restrictions that are coming in, we are now trading at around 12-year highs in the global markets for rice prices there. India has, as of now, restricted almost all non-basmati varieties. We have export duties coming in, or some of the varieties totally are banned here as well. So as I said, India does, non-basmati accounts for 80% of total rice shipments that happen in from India. And India accounts for 40% of all global trade that happens in sense of rice. So when you look at from the Indian markets itself, we have seen a lot of restrictions come in last couple of months itself. I'll quickly put it down for you here. One is the ban on the non-basmati white rice exports. This was the first reaction or the first instance that the government did really take in sense of controlling availability and ensuring that there is not too much price rise in the Indian markets there. And then came in the ban on broken rice exports as well. The latest has been that you have 20% duty in sense of export of parboiled rice, and now there is a restriction on basmati rice as well. This is temporary, as the government notification itself suggests. So a price lower than $1,200 a ton has been halted. You know, that has come in because the government thinks that a lot of non-basmati rice also was going as a basmati rice in sense of exports there. And when you look at the shipment cost, the average was anywhere between $359 on the lower side to an average of $1,214 on the higher side. So as of now, $1,200 a ton has been put on, and anything less than that is something that will have to go to a committee by EPEDA, and then only those exports can happen. Also, when you look at the Indian market's overall numbers, India ships nearly 4 million tons of basmati rice, and we majorly exports to Middle East countries like Iran, Iraq, Saudi Arabia, Yemen, UAE, and US markets as well. And the markets are anticipating shortage in all of these countries there. Also, take a look at what's happening in the international markets. These are the numbers that we send as export in sense of numbers. So basmati at $4.8 billion, we export something like 45.6. This is the number from last year. When you look at non-basmati, the number is really huge, and that is something that India has totally stopped on. So $6.3 billion of work is what we did in the last year at 177 lakh tons. The expectation from the international markets is that with these bans coming in, nearly 10 million tons of export from India could really be getting impacted. And it's not just India. Myanmar, which is the 5th largest rice exporter, also is looking to restrict exports. So many countries really going into that protectionism. Also, Thailand has advised farmers not to cultivate rice so that they can conserve their water resources. So there are concerns when it comes to rice, which is a staple diet for many countries globally as well. Also, when you look at the prices itself, the FOA has said that as compared to last year, we are up by nearly 16% in sense of rice prices. The only plus point really is that the sowing in India is 4% higher than previous year. But with the kind of weather that we've seen in August and expectations of September, the final number is something that you'll need to watch out.
Okay, got that. Major global shortage seems to be in the making. Rice is quite a hot issue. Thank you, Manisha. For that, we'll take a break on that note. On the other side, our special segment, Indianomics. Latha today gets chatting with external MPC members Shashikant Bhinde, Jayanth R. Verma and Ashma Goyal to get a sense of RBI's MPC minutes and the macro environment.
Yeah. Okay. Ashima, you can hear me?
Yeah, I can hear you.
Okay, Dr. Verma, hi. Thank you. Welcome to Especially Economics. The minutes of the Monetary Policy Committee's August 10th meeting show that at least two of the external members, Dr. Ashima Goel and Dr. Verma, were a little more optimistic that the current food inflation spike can be looked through. Dr. Shashanka Bhide sounds a little more cautious. But many events have happened since they wrote their minutes and today. One, the July inflation number came after the minutes were written, and at 7.44%, they're much higher than RBI or the market forecast. Two, August rains have shown some El Nino impact and they have pushed up cereals prices. Three, the RBI MPC members, Dr. Patra and Governor Das, have called for a tightening of liquidity. There was the incremental CRR. This has pushed up yields. And fourth, Jerome Powell over the weekend sounded more hawkish than expected about US inflation. So what are the current thoughts of the MPC external members? I have with me Dr. Jayant Verma, Dr. Ashima Goel and Dr. Shashanka Bhide. Gentlemen and Ashima, thank you very much for sparing time for us. Dr. Verma, let me start with you. Exactly the food inflation number at 7.44, indications are that August is going to be just as bad. Would you be a little more worried that food inflation may be sticky?
No, I think when we met, I think there was a fair degree of understanding that inflation these 2-3 months would be high. I think I was expecting somewhere between 7 and 8 to happen for a couple of months. So I think to me that did not come as a surprise at all.
Okay. So that doesn't require to change your views. But I'll tell you why the market and others estimate that it is worse than expected. The Reserve Bank's July, August, September quarter average forecast is 6.2. Now, if we have a 7.4 for July and a likely 7.2, 7.3 for August, chances are this number is going to be, much higher than what RBI forecast. RBI forecast 6.2, we are probably going to be 6.8 to 7%. That's the CNBC-TV18 poll. Therefore, would you change your thoughts that maybe it's going to be more sticky, Dr. Verma?
No, I think, see, monetary policy acts with fair amount of lag. And we are looking at 3 to 4 quarters ahead. So really, what happens this quarter is not something that we can control today. So we are looking at what would the picture look like 2 quarters from now, 3 quarters from now, And what happens these 2-3 months is really something that monetary policy cannot do anything about. Okay. Even if we raise rates by 5 percentage points, that will not do anything to August, September inflation. So the point of tightening or loosening is related to what we see 3 quarters, 4 quarters, 5 quarters ahead. Okay. So this quarter, I'm really writing that off as saying that this is beyond control now. Okay. And that doesn't change the outlook for monetary policy.
Okay. Let me get Ashima Goel's view on this. Ashima, it's not just that the current quarter will not be 6.2, it's definitely going to be closer to 6.8 or thereabouts. Now that pushes the entire average also. I mean, the poll that we did shows that we won't be at 5.4, probably the average is going to be 5.6. So it's not just going to be a 1 quarter affair from the way the market is reading it. Your thoughts, therefore, that probably would, if you're writing the minutes today, you would be more cautious?
Well, I think I was cautious enough. I said we have to watch incoming data.
Yes.
Therefore, our position will be affected by the kind of, the events you have underlined so well. But I think the key issue really is if this vegetable inflation reverses. Because, as you said, the average will go up only 0.2% for the year, average inflation. And if inflation reverses, then by midsummer, it will be around 5.2, which suggests that our real rate is all right. So that is the key issue. And here, I think we can expect some pleasant surprises on the supply side.
Okay.
For example, the China slowdown, oil, we might see oil marketing companies passing through something. We might see further supply side action by the government. So I wouldn't base an outcome just on this last month or these 2 months. I would wait to see a little longer what other things happen before deciding that maybe food price inflation overall is going to be sticky for longer. And second, even if food price inflation is stickier for longer, cereal, pulses, etc., we still have some components that are falling, like palm oil, etc. And second, it's still something that might not affect the overall inflation because we're not seeing true second round effects, which is real wages must start rising. This is what happened in the really high inflationary period in the 2010s. Manufacturing wages, real wages are only half of what they were pre-COVID. And we are seeing employment softening, services employment softening. So this is when food prices affect wages and then affect food prices again, that it becomes truly persistent and generalized. We're not seeing that.
No, we haven't yet seen that for sure, but the food inflation has just begun. And if it persists, perhaps there will be demands for increases in DA. We also have an election round the corner. So I agree that it would be wait and watch. Dr. Bide, a similar question to you. You actually already sounded a little bit of caution when you said that, we should worry about broadening of inflationary pressures. Those were the very words you used. And now the data has come in worse. So would you have written the minutes differently? Would you have heightened your caution a bit more?
No, I think, obviously the first quarter numbers were very good. That inflation rate was lower, but food as well. And so I think the concern was beginning with the problems with tomatoes and also July numbers. But I think the concern is there, I think, at least until September or so, because I guess this is about the time that the price rise in the case of food products, I think, particularly, there is more momentum and so on. So I think the El Nino effect or the uneven distribution of rainfall and so on, that doesn't sound very good for Kharif harvest, actually. So therefore, I think the concern is there as far as the food prices are concerned. But I think I would agree that in the case of non-food prices, the pressures, I think, are less. So that may be the reason that the overall headline inflation might still be moderate. So in terms of projections for the future, I think this quarter and the next quarter are going to be sort of difficult in terms of the food inflation is concerned. But I think the subsequent quarters, I think, would be more moderate than what we see now.
Okay. Well, we do see some international uncertainty also. And you point out to that, Dr. Bide, that there is also global volatility in agricultural commodities. And of course, there is the hardening of crude prices. So when you all were writing, we were not looking at a consistent $85, $84 for crude. Now that looks like the new normal. So Ashima Goyal, the forecast we have of from the market for the first quarter or FY25 is not 5.2 as the RBI forecast, but 5.4. If it is 5.4, then 6.5 the repo rate minus the inflation rate of 5.4 will be only much less than what we thought. It's going to be 110 basis points. Are you okay with that?
Yes, I mean, I always said that that what I think is an appropriate real repo rate is 1% plus minus because you can't hit it precisely. So we are still very much in that range. And I think that inflation targeting really works because they know the anchoring of expectations, because they know that the MPC is going to react if inflation rises persistently. And a real repo rate around 1% is giving you that reaction. Your nominal rate is matching the rise in inflation at present. So I think that is okay.
Okay.
That should work to anchor inflation expectations.
Okay.
And would be appropriate, because it's not so much that we are dampening demand. What is really important here, there's just one other thing I want to say. I want to contrast our experience this time with what happened in the high inflation episode in the 2010. There, if you remember, after the global financial crisis, there was a huge stimulus which was not reversed for a long time. There was a huge liquidity infusion which was not reversed. Rates were raised in baby steps. This time, the reversion has been fast. We reach our equilibrium real exchange rate quickly. And when the government is taking action, then the government was spending a lot in rural areas on construction and so on, which increased demand for food when already food inflation was high. And so you saw real rural wages rising. This time, the government is spending to cap food prices, giving free food, buffer stocks, etc., as well as fiscal consolidation, reducing the fiscal deficit. So again, these are factors that will prevent that second round effect taking in. And overall, you would expect headline, which is volatile, to approach a more persistent core inflation.
Yeah. All said and done, Ashima Goyal, the current general government deficit is still 6% plus 3%. It's close to 9%, probably 8.9. Not very different. At that time, the government definitely increased inflation, increased fiscal deficit, but we are not at a very low fiscal deficit at this point in time. It is just lower than what it was during COVID. But let me come to and you never know, it's in an election year, it might even rise. But that, I guess, is wait and watch for the MPC. Dr. Verma, you have never given us your idea of what is the neutral rate. Do you think a 1% positive real rate is enough? There were some RBI studies, I think, which were talking about 150 basis points. What's your view?
I think most estimates would be that, one should be somewhere in the range of slightly above 1. I would regard 1.5 as too risky in terms of the growth impact. So I would be very much worried about pushing it up all the way to 1.5. I would like it to remain significantly below 1 and slightly above 1. 1, slightly above 1. So between 1 and 1.25 would be my preferred zone for the rate.
Your thoughts, Dr. Bide, on what should be the positive real rate?
I don't think I have a particular number. I certainly would like to have the inflation rate, projected inflation rates closer to the target that we have. I think that to me, I think that is an important point.
Okay, then I'll come back to that point in just a bit. That's very important. At 5.4, we are actually closer to the upper bound, if that's what the first quarter turns out to be. But Dr. Verma, the other thing that the Reserve Bank has done, which is not an MPC preserve, is the hike in the CRR. And Dr. Patra has gone hammer and tongs at how liquidity can fuel inflation. Now the call rate is actually closer to the upper bound, to the MSF rate. Your thoughts?
You see, liquidity management is a purely operational decision. It is the mechanism through which the RBI implements the monetary policy decided by the MPC, right? So if the market is not where the MPC is guiding it to be, then you tighten or loosen liquidity for that. So liquidity management is not a monetary policy decision, it's an implementation of a monetary policy decision. And that is an operational decision which the central bank takes, that if we want rates to be at the kind of level which the MPC has decided, then do we need to inject liquidity? Do we not? Do we need to take liquidity off? That's a purely operational decision. It is day-to-day management, which is nothing to do with the MPC.
Okay. Dr. Goyal, what would be your thoughts? I mean, the fact that consistently after the policy, the call rate has not been at the repo rate. It has been exactly 25 basis points higher. Everything, call rate, tripartite repo, all the one-day rates are at 6.75.
That's not correct. That's not in line with the MPC decision or with inflation targeting. Because inflation targeting mandates that the Reserve Bank must manage liquidity. All liquidity is supposed to become endogenous. So if the rates are higher than the repo, the Reserve Bank, the VRR short-term kind of liquidity adjustment should be such as to bring the repo rate down to bring the market rates down to the repo. So we should see that happening in the future. And I think that inflation targeting properly implemented should assure the market that we will not go into very large liquidity deficits. Excess large surplus liquidity, as was there before the CRR hike, can kind of leak into the informal sector or low interest rates and fuel. Earlier, there used to be a fear of speculative food hoarding, etc. But I think when you're relying more on trade, that's not such an important issue. And you want to make speculation expensive by raising rates, not by
which is why I guess the Reserve Bank, which is why I think the Reserve Bank has pulled out liquidity. You think that's fair?
Well, they didn't want too much surplus, so it was right to pull it out. But now they have to make sure that the market rate doesn't rise above the repo by injecting short-term liquidity. And if shocks are such, because in the economy you have outflows, you have intervention, etc., they can't do it through short-term liquidity, then they need to adjust the durable liquidity. But for a sustained period, market rate should not be above the repo rate. That is mandated by the MPC.
Well, to be fair, it's only about, 2-3 weeks that it is at 6.75. Nevertheless, it is. Two more questions remain. One, consistently the inflation has not gone to 4%, barring 2 or 3 months when it came to 4.5, 4.6. It's remained above that level. I would want your thoughts. And secondly, growth everywhere is surprising on the upside. Everywhere, as in the United States and in India. Both those questions to my guests after a short break. The Bazaar team will get to Chartbusters, but you will get to hear the entire conversation at the end of the day.